Hello friends, good evening to all of you and about the Treasury Risk Management, the chapter number 4 from the module B of the module C of the BFM. It's not the module B, it's a module C. First of all, let's understand that there is importance of the Treasury Risk Management and it is twofolds. The first thing that let's say discuss is that the treasury operations, they are going to generate the profits through the market opportunities. So we are going to use a different market points like about the capital market, money market, foreign exchange market. So definitely when we are using the multiple opportunities so as to generate the profits, definitely there will be the risk at each and every stage. And also, the treasury manages the balance sheet risks which are arising from the banking operations, right? We are managing the balance sheet risks also. And the treasury is definitely of very much high leverage, like the higher leverage is there. So, higher leverage means the higher risk exposure is also there. And if the losses are there in case of treasury, those can be very much instant, those can be of large quantum, and those are irreversible. That's why the treasury risk management is required. Why? Because the first point is that we are looking for the different market opportunities for the different markets. So definitely there are risk in the market at every stage. The second thing is related to the treasury itself is managing the balance sheet risk. So definitely the risk is there. And moreover, there is so much leverage that is there in case of treasury. That's why we was basically want to let the losses which can be there, those are instant, those are large, those are irreversible. So definitely we must be having dealing with the treasury risk management. Now, what are the different concerns in treasury risk? The first thing, it's about the high leverage risk. So there is very high sensitivity toward the leverage risk in case of the treasury. What do you mean by leverage? You're having rupees 10, you're investing in rupees 1000 security. So that's the leverage. And when the leverage is there, definitely the much more risk is there, right? You want to cover it. So low funding is required, but the large exposure is there and we want to deal with it. So high leverage is there, right? The second concern is about the large deal size. So the deal size in case of the treasury, those are comparatively very large. And the decision taken by the dealer are without prior approval. Those are without prior approval. So that's a second concern. And the third thing, the transactions which are being done, those are irrevocable transactions. So the deal size, we have learned that the large size of transactions are there and those are at the discretion of the treasurer, means the prior approval is not there, and the such transactions are irrevocable transactions. Those are irrevocable, those cannot be cancelled. Once you have entered into transactions, those transactions cannot be cancelled, so no correction would be possible. And whatsoever the losses are there, those are very much instant. So the loss does basically materialize in a very short term. If the losses are there, those materialize in a very short term. The immediate impact will be there on the bank profitability. That's a very major concern. And also, the market volatility is very high. There is variability in the markets. Now, variability is basically concerned to be volatility. So higher the volatility, higher the risk or lower the risk. If the volatility is higher, the risk would be higher or the risk would be lower. So higher the volatility, higher the risk is imposed. Lower the volatility, lower the risk is imposed. And in case of the treasury, we are dealing with the multiple markets and markets are volatile. So definitely the exchange rate volatility can be there. The securities interest rate volatility can be there, right? So we do face the different types of risks in the case of the treasury. We do face the funding risk. We do face the market risk. We do face the liquidity risk or the funding risk, we say credit risk, right? The different types of risks are there. So what type of risks are being faced? We are dealing with the market risk, the liquidity risk, or we say it to be the funding risk, or the credit risk is also there in case of the treasury. When do we face the market risk? When do we face the market risk? The market risk is being faced because there is fluctuation in the prices. There are price fluctuation. We also say the market risk to be the price risk. One and same thing. Market risk is said to be the price risk. So there is fluctuation of the prices in the market, right? So the interest rate risk is there, the forex risk is there, the price volatility risk is there. So that is basically the volatility. That's the variability of the prices, right? And also there is the liquidity risk, or we say to be the funding risk or funding risk. Why the funding risk is there? Because the risk of funding, or let's say liquidity risk, is the risk for the inability so as to meet the settlement obligations. Let's say you are to pay rupees 1 lakh with to the customer, but you're just having rupees 70,000 with you. So there is shortage of funds of rupees 30,000 with you. That's about the uh, funding risk or liquidity risk. So the liquidity risk may be there due to the cash flow mismanagement, or it could be there due to the short-term borrowing needs, right? So it is basically caused by the cash flow mismatch. It is caused by the short-term borrowing needs. Clear with it? And definitely, if the liquidity risk is there, it will lead to what? That you are to borrow from the market at a higher rate. Let's say having an obligation that I'm to pay 10,000 USDs to the customer A, but in my Nostro account, I'm talking from the bank behalf, right? So in my Nostro account, I'm having 9,000 USDs only, right? Now I'm to pay 10,000 USDs. Now I'll be borrowing 1,000 USDs from the market. Now, it may be the case that I won't be able to mobilize 1000 USD at a less price or at a reasonable price. I'm to pay a higher price. So it will be decreasing my overall income. My overall net margin will be reduced, right? So that's about the liquidity risk or funding risk over there. Clear with that? Okay. Further, liquidity involves what? It involves managing the cash flow mismatches. If the liquidity is not maintained, the interest cost will go up, and sometimes the viability of the bank operations is also threatened. And the third type, it's about the credit risk in treasury. Credit risk in treasury, like the default risk. Now, what do you mean by default? When the counterparty fails to repay, let's say there was a deal between the bank and the other party. Now, the default is by the other party is there. That there is default by the other party. Now, it may lead to what? That you are not getting the funds, or the particular scheme is not going to basically obligated by the counterparty. So it's a credit risk is involved there. So all three types of risks is there. The liquidity risk is there, right? And further, the market risk is there, and also the credit risk is there. This is about the type of risks: liquidity risk, market risk, and the credit risk. All three are there. All three are there. And in case of the credit risk, we are having the two types. One, it is related to the default risk, like when the counterparty is defaulting. And the other one, it's about the settlement risk, the risk which may be imposed at the time of settlement. Let's say the counterparty fails to deliver the funds or securities. That's a settlement risk. Now let's have a look at the let's have basically look at the treasury risk control framework. So this is about the next topic that we are going to cover. It's about the control framework. So there are the internal controls, there are the organizational controls, there are the exposure ceiling limits which are being imposed, right? And these are the measures. These are the supervisory measures or the conventional controls, like the preventive steps we can be taking, right? So as to reduce our risks, so as to control our risks. So it's the control framework. So the first thing over here, it's about the organizational controls. The second one, it's the exposure ceilings. And the third one, it's about the limits on trading positions and the stop loss limits. So let's consider the first one. It's about the organizational controls. Now, if we look at the organization structure, we have already discussed that we are having the front office, the mid office is there, the back office is there. The front office does what? So it simply executes the deals with the counterparties. So the deals are executed by the front office. And for the mid office is going to do the risk monitoring, accounting, settlement, reconciliation, that is being done by the, that will be done by who? Risk monitoring will be done by who? It will be done by the mid office, right? Policy compliance will be done by whom? It will be done by the mid office. And what the back office will be doing? The back office confirms the deals. Accounting will be done by them, not by the mid office. Accounting is done by the back office. Settlements are being taken care of by the back office, right? So there is segregation of the duties, like the clear segregation of the duties there. And for the deals are being confirmed independently, and the related to the board policies, related to the RBI policies, the compliance is being looked into, right? So it basically refers, when we're talking about the organizational control, it means there are multiple tiers in the system, or let's say we can say that different departments in the system, and each department is to follow their own rule, right? So treasury is basically divided into three parts: the front office, back office, and the mid office. The front office generate the deals, the back office is basically responsible for the confirmation, accounting, and settlement. And for the independent confirmation is basically obtained by the back office for each deal and about the counterparty. And the back office is there so as to verify the rates, prices mentioned in the deal. And further, the overall responsibility for compliance with the exposure limits, position limits imposed by the management, imposed by the Reserve Bank of India, that is also with the back office. And the middle office or mid office is responsible for the risk management purposes, for the MIS purposes, for reporting purposes, for treasury compliance purposes, right? So these are the duties being played by these offices. That's about the organizational controls. The second thing, it's about the internal controls. We also say them to be the trading control. The internal control, or we can say the trading controls. Now, first thing, it's about the deal size limit. It's about the deal size limit. Deal size limit means what? That the maximum value per transaction which can be there. And it is applicable only to the trading deals and not to the merchant deals. So when we are trading, the internal control is there that the maximum deal that you can be entering into, the maximum deal that you can be entering into, that would be what? That will be decided by the board policy, or let's say some RBI compliance is there related to it. So this is a deal size, like the maximum limit that you can, maximum size of the deal that you can be entering into. Let's say you cannot be buying more than 1 lakh USD in one particular transaction, or you cannot be trading in one particular transaction. That's the deal size, but it's not related to merchant transactions. It is just related to the trading deals and not the merchant transactions, right? The second limit could be there related to the open positions. Now, what do you mean by open position? Open position like the overbought position, or let's say oversold position, right? So even if you're overbought or oversold, you are having an open exposure with you. Let's say when the buying contracts are more than the selling contracts, that's a overbought position. When the selling contracts are more than the buying contracts, that's a oversold condition. In both the conditions, your exposure is open. You're having an open position, and it is basically facing the exposures. You are facing the exposures. And if there is fluctuation in the prices, definitely you have to face the risk. You have to face the risk, right? So the multiple limits can be imposed. Like it could be related to the daylight limit can be there. Like the daylight limit can be imposed upon you, right? Daylight limit, like for the intraday exposures I'm talking about, intraday positions we are talking about. Let's say the dealer purchases a currency in the morning and sells in the afternoon, right? So it basically pertain to the intraday position we are talking about when we are talking about the daylight limit. Or it could be the overnight limit, the maximum exposure that you can be taking over to the next day, right? So the lower risk tolerance is there in that scenario. And it could be related to the currency wise position. Like for each currency, this particular exposure open position can be taken care. It could be related to the aggregate limit, like for particular purpose for all the currencies altogether. Like aggregation of the currencies can be done and the overall exposure can be like limited using this particular limit. So these are the multiple limits which can be there. These are the multiple limits which can be there. Is that clear? And further, it's about the stop loss limit. After that, it's about the stop loss limit. Now, what is the stop loss limit? Like there is a limit which is basically related to the, let's say you purchased a share at rupees 100 and the stop loss limit was defined at rupees 63. Now you were basically anticipating that the prices will go up, but those are going down. It became 80, then coming to 70. The moment it will hit 63, you are to scare off your position. Means you have to sell the whole lot of the shares that you bought for rupees 100. Why? Because doing that, you will be limiting your overall loss. Now, even if the prices are going down, let's say 2 rupees 55, now your loss is contained 2 rupees 37 per share because you sold the share at rupees 63 already. Now your loss is contained. That's a stop loss limit, right? So it can also be fixed. So if the markets are, moving adversely, the open, if you are having the open position, right, definitely you can be facing the losses. And if you want to contain that particular loss, you should be having a stop loss limit with you. You must be having a stop loss limit with you. So you are not to wait indefinitely and you can be limit your losses, right? And the stop loss limit can be prescribed, let's say for per deal basis. It could be related to per deal basis or it could be related to per day maximum loss that we can be taking away, or it could be related to maximum loss that we can taking per month. So for the different time horizons also it can be defined. Clear with it? It's about the exposure ceiling limits. Now exposure ceiling limit is basically related to what, that the maximum exposure that you can be taking, and it's basically prescribed by the Reserve Bank of India, right? Like the exposure limits are there so as to protect the bank from the credit risk. And I already told you that the treasury also faces the credit risk, and the credit risk is divided further into two parts. Like we are having the settlement risk, or there is a default risk also. There is a default risk also. Default risk, like the counterparty defaults into it. That's a default risk, right? So what do you mean by default risk? Default risk is like when you are dealing with the counterparties. Let's say the counterparty is the bank or any other member bank or something. And further, the borrowing bank fails to repay the amount on the due date. That's the default risk. And default risk is even there in case of the repo transactions. Even in the case of the repo transactions, the default risk is there. The default risk is there. And further, even though the interbank market is very low risk category, or let's say we consider it to be relatively risk free, but definitely, let's say if a weak bank is there, that may become bankrupt, right? And further, definitely, let's say the liquidity may be squeezed, right? And ultimately, you will be facing the issues in that. Right? Even if we assume that when you're dealing in the short-term lending, there is no risk into it, but definitely the treasury is lending the entire surplus to a single bank, or let's say to the handful of the banks, and if that particular bank defaults, then definitely the default risk can be there. The second type of the credit risk that we discussed is about the settlement risk. It's about the settlement risk. And when we are talking about the settlement risk, we are to take care that also the Herstat risk is there. I've already explained the Herstat risk to you. What is Herstat risk? Let's say the bank A is in the earlier time zone, right? And further, it has lent the money to the bank B. That's basically in the later time zone, right? And further, the bank A has basically accomplished its part. The bank A has made the lending, but the bank B, who is in the later time zone, which was to pay, was unable to pay, and at the same time, it was basically bankrupted. Now that may face a settlement risk. That is basically set to the settlement risk. Agree with it? So settlement risk is basically the possible failure of the counterparty to the particular transaction, right? That's why ideally all the transactions, all the deals must take place in DVP. Those all the deals must take place in DVP. What do you mean by DVP? DVP means delivery versus payment basis. It must be on delivery versus payment basis, but it is not always the case. But that is not always the case with it, right? Further, it's about the exposure limits are being fixed. Exposure limits are to be fixed. But when we are not following the DVP, what system we do follow? Actually, like we are to follow the PVP system now. We should be following the PVP system, that is payment versus payment system, right? And let's have a look at the basis for the exposure limit. That what should be the basis, that how the exposure limits should be fixed. So we can be looking into the counterparty's net worth. That's the first point. So we should be going for the counterparty's net worth. Also, we should be going for the market reputation of the particular entity. We can be looking into the credit rating. We can be looking into the past dealings, that how they have behaved, or what is their financial strength or nature of exposure, whether it is secured or unsecured. Based upon that, the exposure limits can be set. So exposure limit is basically the limit you have to fix toward the entity you're dealing with. Let's say we are dealing with some entity which can be defaulting. So we'll be setting up a lower exposure limit. And for the entity which is secured one, we can be setting up a higher exposure limit, right? So that is the part related to it. That what should be the basis? What should be the basis when we are setting the exposure limit? We can be looking into the counterparty's net worth, the market reputation, the credit score or credit rating. We can be looking into the nature of exposure or something, right? That's about it. And how we can be reducing the exposure limit. So if we are to reduce the exposure limit, if we are to reduce the exposure limit, how we can begin reducing it? First of all, we are to do the diversification. Now, what do you mean by diversification? Diversification means we should not be lending, we should not be having the exposure to the single entity. Let's say we are having the exposure to the multiple entities. So in that scenario, even if the one party defaults, we are still earning from the 9 entities. So we should be spreading the business across the multiple counterparties. And the tenor based limits must be there. Tenor based. Like if it is for the overnight exposure, we can be going for the higher limits. For the let's say 1 month, 3 months, 6 months exposure, we can be going for the lower limits, right? And let's say particularly for the longer tenure, we should be, because their higher risk is involved, so we should be having the lower exposure ceilings for the case, right? So we should be limiting in that sense also. In period, in the limit vary in relation to the period of exposure. So for lower tenor, we can go for the higher exposure. For overnight exposure, we can be having the higher limit. For the medium term, let's say 1 month, 3 months, 6 months, we can be having the lower limit. For the long tenor, where the more risk is there, we can be having the lower exposure setting. We should be having the lower exposure settings, right? And also the product wise limits can be there. You can be going product wise also. It's not like that you have to go for the amount wise or tenor wise. You can also be working product wise. So the third point, it's about the product wise exposure. Now, if you are lending and you know the credit cards when you're sanctioning, those are basically carrying higher risk. So you should be lending less in the credit card segment, right? Because we know that's a riskier concern. So you can be limiting your, let's say, overall exposure related to the money market, related to the derivatives, related to the Forex accordingly. And also, we can be setting up the broker limit, like the limit basically fixed with the money market brokers, or let's say the limit which is fixed with the capital market broker. So broker limit can be there. Further, the review and monitoring is to be done. The review and monitoring is to be done. So it's the another point. The fifth point we can say, that's about the review and monitoring. And it is to be reviewed at least once in the year. At least once in the year, the limits are to be reviewed. And it is the responsibility of the back office or the mid office so as to ensure the treasury compliance. So it's the responsibility of the mid office or the back office as to ensure the strict compliance with the limits. And if there is any breach, that should be monitored, and any exception that should be reported. That should be reported. So these are the 5 points related to it. 5 points related. The one, it's related to, we discussed about the default risk. The second, we discussed about the settlement risk is there. And also, what are the basis for the exposure limits that we looked into, like the key practices that we should be following, right? So we should be going for the 4 point strategy. One is related to diversification. The second thing, it's related to the tenor based limit should be there, and the product wise limit should be there, and also the broker limits can be imposed, right? After that, it's about the market risk and the credit risk. The market risk and credit risk. Definitely, the market risk and credit risk are being faced by the treasury operations, right? Treasury operations are exposed to the two major category of the risk, credit risk and the market risk. If we look at the credit risk, I have already explained this to you, like credit risk is the default risk or the settlement risk. So there is risk of loss due to failure of the counterparty, that they are not able to meet up the obligation. The counterparty is not able to meet up the obligation. So the lending risk is there, right? Settlement failure could be there. And when we're talking about the market risk, the risk due to fluctuation in the market prices, due to interest rates, due to exchange rates, due to the security prices, that is the market risk. And market risk is having the multiple components. The funding risk is, or the liquidity risk is the part of the market risk only, right? So when the liquidity risk is going to rise, when the liquidity risk will be rising, any idea? See, the liquidity risk does arise when the bank is not able to meet its cash flow obligation. You were to pay 10,000 USD. I gave you the example. You are to pay 10,000 USDs, but you are having the 9,000 USDs in your account. Then you are to basically get 1,000 USD from the market, and you may not be able to get it at the reasonable price. So when we are not able to meet our obligation in time, right? That's basically is the liquidity risk. That is a liquidity risk. So it could be related that you are borrowing in the call market. Like, let's say, let me explain to you. Let's say we are borrowing in the call market. Borrowing in the call market. And when we are dealing in the call market, call, term market, right? Notice market, you know that now. So when you are borrowing in the call market, let's say for the short term duration, when we are borrowing, and further we are investing, let's say in the long terms. So we took the money from the call market and we invested the money in the long term government securities, right? We were anticipating that in the single day we'll be making a profit, but the bond prices does fall. The bond prices are now lesser one. So you were basically assuming the bond prices will go higher and you'll be selling at a higher price. So I just borrowed the money for one day, let's say, and I took a amount of rupees 10 crore from there and invested that money in the long-term government securities, keeping in mind or anticipating or speculating that prices will go up, but the prices went down. Now I'm not cannot be selling at a loss. Cannot be selling at the loss. So in that scenario, now I'm forced to borrow rupees 10 crore at a higher cost. So this is how the liquidity risk is being imposed, right? Clear with it? The second type of risk that can be there in case of market risk, that's the interest rate risk. And what is interest rate risk? When there is adverse movement of the interest rates, and let's say it's impacting your NII, your valuation or the asset valuation is basically reduced. Your net income, your net interest income is reduced, or let's say the valuation which was there that is adversely impacted, valuation is reduced. That is said to be the interest rate risk. So let's say the in common sense, I'm talking not from the treasury point of view. Let's say the repricing of the assets and liabilities being done. Repricing means that after some particular tenure, the interest rates, which are basically a floating interest rate based upon some benchmark, those will be changed as per the underlying benchmark, right? So assets are the loans and the liabilities are the deposits. So both are repriced. So previous interest rate was, let's say I was earning 11% on the assets and was paying 7% on the liabilities. So my net interest income was 4%, right? But now the interest rates are working adversely. Now my new interest rate that I'm earning on the asset is reduced to 10%, and the overall cost that we were to pay on our liabilities increased to 8%. My overall net interest income is reduced to 2% now. The spread is reduced to 2% now. This is due to what? This is due to the adverse movement in the interest rate. This is due to the adverse movement in the interest rate, and that's going to impact your overall profitability, right? Or it could be the case that your valuation is reduced. Previously, your portfolio was valued 10 crore rupees, but now the interest rate is altered in an adverse manner. Your overall profitability, your overall, let's say, portfolio value is reduced to 9.5 crores. So that's also about the interest rate risk. So what areas are basically being impacted? What areas are basically being impacted? So it could be the case that there is increase in the borrowing cost. Your borrowing cost may increase, your income from the assets may decrease, right? And also there can be a crash of the bond market, like a steep fall in the bond prices, that can be there. And what are the sources? It could be due to the mismanagement or mismatch between the assets and liabilities, that we say to be the asset liability mismatch. It could be due to the asset liability mismatch. When the gap is there, we say to be the repricing gap, or we say to the gap risk over there, or it could be due to the fixed or floating rate mismatch. So higher the mismatch, higher the risk is there. Higher the mismatch, higher the risk is there. And under the treasury portfolios, especially when we're talking about the bonds, those are highly interest sensitive, right? The third type under the market risk, it's about the currency risk. When the currency is fluctuating, the exchange rates are changing, definitely the currency risk is there, right? It could be due to the inflation or interest rate differentials or the money supply or capital flows. And further, you can be managing it through the hedging of the instruments. Now, when we'll be discussing the derivative partner, you'll be understanding what I'm trying to say. So it can be like managed through the hedging, when we can be buying the or entering into the derivative instruments. Like we can be managing the open position limits. We can be managing the open position limits. We can be managing the gap limits. Right? That's about it. And further, if we look at the regulatory aspect, if we look at the regulatory aspects, we can be looking for the NOOPL. Now, what is NOOPL? What is the full form of? I'm just going to explain you the NOOPL full, like the complete form of the NOOPL. What is NOOPL? It is a net overnight open position limit as prescribed by the Reserve Bank of India. It is net overnight open position limit. So maximum permissible unhedged foreign exchange exposure that the bank can carry overnight. So it is as per the Reserve Bank of India framework. So if you're having the NOPL, overall risk is, let's say, is lesser one. Why? Because it is net overnight open position. Net open position means, let's say you were having the buying contracts of 1,000 crores and selling contracts of 950 crores. Now it's a overbought position or oversold position. Definitely you are having an open position, but it's an overbought position or oversold position. Which one it is? It is the overbought position. We are having the more buying contracts than the selling contracts. Now, if your, let's say, NOPL is, let's say, 10%, like the overall open position that you are having, which cannot be hedged, is like you can be, you have to hedge 90% of your open position. In that scenario, I'm having the open position of 50 crore here, and out of 50 crore, 90% is to be hedged, means 45 crore is minimum to be hedged as per the NOPL limit, and 5 crore will remain unhedged. So this will basically be improving our overall efficiency, and overall risk management will be improved. I hope that you must have understood the concepts related to it. If clear, so do like the video and further share the video at the earliest, and simply just do write CAIB. If you want to get the complete pack, complete course related to all the 5 papers of the CAIB, just simply do WhatsApp CAIB and WhatsApp it to the number 83609 I'll be sharing the complete details to you, like, and you'll be getting the full course videos, chapter wise previous year questions, mock test, mega test, PDF notes, each and everything. The case study videos will also be covered, right? So that will be all. Thank you so much and see you again in the next video.